All right, had to reload the stream. Let's see if this is working now. Okay, I'm getting viewers coming in. Okay, great. So it is time for another Friday close. And when I started this week, I wondered, because it was such a short week, if we're going to actually have anything good to talk about. But this has been a very interesting week. So we have a lot of good stuff to go through. Really kind of excited about this. Had my afternoon coffee, and it's been a pretty bullish week. Looking at the SPY right now, on Thursday, had a little bit of a scare to, I guess, some people when we dipped down all about 1.5%. And yeah, that's not very much in the grand scheme of things. Let me make sure that everything is working. Can you guys hear me? Say something in the chat if you can. Just want to make sure, because what I do is I dual stream this through TradingView and YouTube. So hopefully it's working out just fine. Okay. Looks like we're getting some kind of response. Great. Excellent. Excellent. So yeah, this week, coming into this week, every week I get about a few, not that many, but a few people asking me what to do about a potential market crash. And that's what I want to lead with now, because we've had a little shakeup this week that made some people a little nervous. But at the end of the day, or at the end of the week, we ended up making a new all-time high. And you really just kind of have to assume that. Now, there is going to be a crash eventually, one of these days. I mean, if you look back in the history of the SPY, it actually, if you look at how bullish this is, yeah, it would make anybody nervous. And someone came in to this week asking me a question like, "Hey, I want friends and family. They're telling me that, there's a crash coming for this reason, blah blah blah. So, what if I stop myself out and get back in when the market starts going up again? Like, can I do that? Like, is that a way to, not lose on the downside but still capture the upside?" No, that does not work. I wish it did. I wish I could tell you that it worked, but it does not work. It does not work statistically. It has not worked in the past. And there's reasons for this. If you Google it and you look for some sources, you'll find some on CNBC and all these other things where people talk about time in the market is better than timing the market. Well, that's because there's math to back it up. I saw this really relevant article where it talks about the different performance based on how you would have altered your portfolio as you go along through the market. The key thing here is if you miss the best days of the market, you miss out on a lot of the growth. That's the key. And the irony of these best days, and I was trying to find an article that explicitly looked at days following crashes. This one right here, I'll go ahead and put this in the chat for people to go to if they want to look at it, is right here. Yes, we'll get to some questions when I get to off my soapbox. So yes, free trial 2005. We'll do that. So what I really wanted to emphasize, though, is what happens in days after big down market days. If we look at the most recent crash in 2020, this big down move that we had in March, culminating at the bottom on March the 23rd, we had an almost as fast reaction back to the upside. Just as you had big red bars here, you had big green bars here. So this red bar here on the market going down was almost a 5.73% down day. And the up day here, a few days later, was almost a 5% up day itself. And these are the things that you miss if you're waiting out the market. Because I guarantee you, if you got out right here, you're going to be waiting for probably a little more than this to get back in, and you're going to miss these rebound days. And again, this is just the SPY. This is not looking at your individual stocks, which can be even more volatile, and they can recover even quicker. I had a member of the Discord who had an idea for trying to time the market, something very, very simple. They were going to use EMAs on the weekly. So they were going to use a EMA on the weekly chart and look for crosses here. And so basically what they were looking is whenever the 6 EMA crossed over the 10, they would either get out, and if it crossed bullish, they would get back in. And that would hopefully, if you look at enough, let you have a better performance. Well, I actually sat down because I find these questions very interesting and did the math. I did a spreadsheet of it and went through some relative performance and came up with this. And this chart right here, which I'll compress down a little bit so that we can see it all at once, and then we'll expand it out because I just like using Google Sheets. I'm sure there's better platforms out here for performance, but this has worked for me. So the red line is the S&P SPY if you had just hodled. If you just bought the same amount, $10,000 worth at the start of when I started collecting data that Google Sheets was able to give me back in, I guess, 1993. And then the blue line is if you had tried this strategy. In other words, when the 6 and the 9 crossed, you sold bearish, and when it crossed the other way, you bought back in bullish. Now, a couple of things you can see with your eyes here is that the performance during real bear market conditions is almost the same. Back in 2000, when the market was on its downturn, you were out of the market at several points, and they kind of got close to each other around 2002, 2003. But then, of course, as the bull market continued on, they diverged. Then in 2008, you come down and you're out of the market round in the very bottom of it, and it performed similarly up until about 2011, and then they began to diverge again. And yes, Tyler brings up a very good point. This is not including commissions. This is not including taxes. You know, some might say, well, I'm going to do my Roth IRA or I'm going to do my 401k, so I won't be taxed on it. Okay, you can avoid that, but that's not really the risk here. It is a big tailwind against you, but let's look and see what is actually going on when we look at some of these things. I'm going to zoom in by hacking my way into a bigger, closer chart because I don't have a magnifying glass. And let's just look at a few of these key things right here. So we'll look at 2008. Well, it had you out of the market when it was going down. Yeah, you avoided this big down move right here, but right at the end of where 2008 was bottoming out, the performance came right back to basically dead even. You got back in at the same time. You avoided this down move, yes. But as the bull market continued, here is what ends up happening. Notice this period in 2012. You have this down move here around June of 2012 where you get out of the market and you're out on your strategy. But meanwhile, the market has already started rebounding up several percent while you're still out. Then you get back in and you've missed this up move following the bearish condition. Same thing happens again in 2016. You have a big sharp up move that your indicator can't really catch fast enough for you to get back in and capture. And the same thing happens in 2018, where you're out of the market when you have big violent moves up, and then you didn't re-enter the market in 2020 until May. And so you missed all this rebound, but you still, because you're using EMAs, taking a lagging indicator, you're not going to avoid all the downside. And so as you get into a bull market, you're just really hurting your performance because you're not capturing those big moves up. And as a microcosm of that, if you look at this week's activity, you know, we had this big sharp move from an all-time high that we set on Wednesday down to this action we had on Thursday, sharp, violent move. And now, one day later, we're back at the all-time high. If you would have taken this as a sign to get out yesterday, Thursday, you would have gotten scared. You would have missed all the recovery and you would have missed the gains from, let's just say you bought at the all-time high. You would have missed about 0.25% here. And then whatever else happens in the weeks to come. there is a crash coming, and there's plenty of YouTubers out there that are going to give you all kinds of good reasons why it's going to happen tomorrow, because that's sensational. It draws people in. It makes people like, what's going to happen? It's because everyone likes to. I don't think everyone likes to be afraid, but people are definitely drawn to fear. The end of the day is you can't rely on yourself to get in at the exact right moment. And I have a lot of friends that got out last year or even got out at the beginning of this year thinking, oh, well, this is going to be the top. And they're still waiting. They're missing out on, I definitely know friends that got out in the first quarter, January of this year, who have missed out on the 16% returns. I mean, what were they trying to avoid? You get, statistically, every other year, that means 1 to 2 years, you get a 10% down move on the SPY, on the market. That's a correction. Once a decade, you get a 30 to 40% down move. So 2008 was a bear market. That was a 40% move. Same thing back in 2000. Last year, 2020, about 2 years late from 2008, we got our 30% move. And a lot of people will say, oh, well, that's not really a bear market because reasons. It was still statistically where we would have expected it to be once a decade, this kind of bear move. So what you can expect is at some point between now and 2022, you're going to get a 10% down move on the SPY. But if you had cut yourself off because you thought you were smarter than the market at January this year, you've cost yourself 15%. That's just the math of it. By sitting out and being fearful, you're missing out on these gains. And yes, it's scary. It really is to look at a chart like this, which looks like a meme stock in itself, to have it going up, 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 up. And I use Ichimoku, by the way, because that's my favorite way of kind of trend following and analysis. And so if you're looking at where we could go and what should make people fearful, well, what I would look to see is a 10% move, like I'm saying. So where would a 10% move take us? A 10% move would take us somewhere around here, where depending on what time it happens, would be basically a pullback to the weekly cloud. So that would be healthy. It would suck in the short term, but I would like to see a pullback to the weekly cloud to blow off some of this bullish momentum and all this euphoria. But if you want to know when to get really fearful, you look at the daily. The daily is a great container, trend-wise, of trends. And if we look at the SPY for the last, about 18 months or so, coming off of the bottom here in March, if we just see where price got out of the cloud here, it has come into the cloud a little bit, maybe violated a little bit here, but it hasn't crossed over. Where you would want to get really fearful of a 10% or even the 30% move is if you start getting into, from this point here, as we're talking right now, the 400 range. That could get a little scary. Where does that look like on the weekly? Well, that's still within the realm of that 10% pullback. So we could come all the way back down to the 400, even the 390 range, and it be considered a statistically normal once an 18-month to 2-year pullback. But we've already gotten the 15% for the year, so we've already made our money up to that point, and we don't know when it's going to happen. So yeah, this time it'll be different. It's always different. It's like, no, it's never different. It's never different. It's never different. So that is what I think about the SPY right now, making an all-time high. It's if you just kind of excise from your trading sentiment and personality that you need to capture the all-time high, that you need to catch that top, just take a little knife and scalpel it out of your brain. Give yourself a lobotomy of this major fallacy, and you'll be a lot better in the long term. The market crash is going to come, but you will see it coming. And a question I got before we got in here through Discord was, what can we do to maximize our profits in that situation? Well, I'll tell you. If you wait for that confirmation to happen, that's all. Just wait. Just wait for the market to actually turn. Yes, you're going to lose on some of your gains that you've had in whatever. You may be in short-term moves, you may be in weekly options, and they're all going to get blown out, but they were lottery tickets anyway. But once you see a situation like this set up, and I've made videos about this multiple times, again, on the daily, you let price get below the daily Ichimoku cloud. And at that point, you will very often get another thing I like, which is a 50% pullback to a resistance. Take the down move, measure it out, and you'll see a level here. There was 2 days here, March the 3rd and March the 4th, where you had a chance to sit there, patiently meditate a little bit, and decide, we might be going into a bear market. I might want to take some profit. You didn't have to panic sell here, but you had an opportunity there. And at this point, you start looking for shorts. I will have no problems with you buying SPY puts when something like this happens. No problem. Trying to buy SPY puts at the top, unless they're a hedge against existing long exposure, you're an idiot. Sorry, you're an idiot. I don't know what you're thinking about doing in a bull market buying puts, but when you go into a bear market, not only do you have the advantage of puts printing money from this price movement, but at that point, volatility, IV, the VIX, is expanding dramatically, meaning all of your options are becoming worth more and more. You get a double whammy of the short delta and volatility expansion. So your options are just worth more overall. It's a fantastic environment to make really fast money if you didn't panic, if you didn't get emotional, if you just looked at the price that was in front of you. I've talked about this in videos before, but if we go back and we look at 2008, which a lot of people probably were not trading in, let's just take this off a little bit because it was a much longer trend, but you had this period here from 2007 to 2008 where things were getting very slow. There were all-time highs in here, but these are some pretty significant down moves. It's a very different market condition than what we have. Price had been making crazy gains all the way from 2003, just sort of like what we're seeing in the last few years. But then you had a whole year a very choppy price action. It's very different than what we see here. And from the top down to here, you had another bear movement, which would have gotten a lot of people nervous. And then right here, around the time where you got to that 50% level, you topped out for a few weeks. Again, you have plenty of time, multiple days, to sit there and evaluate what the market's doing, set yourself up on the short side. You didn't need to catch the top. You just needed to wait from the 1st of May into the 22nd of May. The whole month of May, you could have just sat down and been like, now I have reason to be bearish, and start looking for short setups. And then you would have had almost 2 years to make money on the short side. A lot of money on the short side. That's what you have to do. That's how you buy SPY puts. You have to wait. On any given day, it's best to be long the market. Now, the other side of that is that's come up in Discord. That's why I love having my Discord. If you're not joined to it, make sure that you do. I don't charge people because I don't need your money. I just want to talk to actually smart people. So if you come in there asking when moon and things like that, I'm not going to answer that. But there's been discussions about selling put credit spreads. I'm not against selling put credit spreads. They're not my favorite strategy because they have an inverse reward risk profile. In other words, if they don't work, you lose more than you potentially gain, but they have a very high probability of success, sometimes 85%. For people who like to win a lot, it can work. But we talked about this in Discord earlier. You know, what you do with a puts credit spread is at periodic events, you know, using weekly options. I prefer to use monthly, so I'm going to, but you can sell these puts credit spreads. That mean you buy, excuse me, let's start with a selling a put. Let's just say we sell the 426 put, and then we buy the 420 put below it. That way we create a zone that we don't want price to get into. And as long as it stays above this level, we make money. And then every few weeks or every few months, you do that. And yes, occasionally in these sort of down moves here, you would take a loss, but you're consistently printing money, sometimes to the tune of 70 to 85% of the time. The only way you really get in trouble is if you get too big. So make sure you keep it small. So I'll talk about that in a video here independently. That would be a good topic for discussion otherwise. But let's look at some of the questions in the chat. If you got questions in the chat, just say hello and ask your question. I'll try to touch on them. If not, I'll keep talking about my my list of things I want to talk about today. In 2008, did Ichimoku work too? Hopefully I answered that. In 2008, the trend was much longer. And so I keep my Ichimoku settings consistent with the classical settings. Those were the ones that were laid out by Gosha Hasada back in the 1930s. And a lot of people that trade crypto, they think, oh, well, we need to change them to 30, 60, and okay, whatever, Zoomer. I keep it consistent. And if you want to look at longer time frames, if you think that they're not appropriate, just go up in a time frame. So instead of looking at the daily now in 2008, I'm looking at the weekly. And so in the weekly, again, same sort of trend analysis. Price got below the cloud when momentum was as well. Now you have a very bearish setup in January of 08 when price got below the cloud. And one of the reasons that I don't use Ichimoku exclusively is because while you'll notice a lot of these levels, like here is the Kijinsen, you notice how it goes flat right here, just like the SKB is flat. It's telling you where those 50% levels are. And that's why I use 50% levels, because I trained myself on Ichimoku for many years, but I still want to go back and validate them independently and make sure that, okay, yeah, this is the 50% of the move that I'm trying to analyze, this down move right here. But Ichimoku is a good thing to look at. The name itself is one glance equilibrium chart. So at one glance, you can see if something's trending or not. And that's going to be price above or below the cloud, pretty simply. So your Discord is telling me you don't have permission to talk in there. I will send me a message on Discord if you see me CIO on there. We'll try to get that permissions right. Jen, what did you do to my permissions? We'll fix it. We'll fix it, Jerry. What is the let me in GIF on your screen? That's coming up. So any more questions about the SPY? I know we got a little bit of a lag, but yeah, I want to talk about that. Oh yeah, you have to complete a CAPTCHA, by the way. It's a bot catcher we have because we get lots and lots of bots because apparently some people still buy stuff that bots are selling. Stop it. So let's take a look. Why do I have up Let Me In by Andre on here? Well, you know who posted this in Discord. And this was about NEGG. Newegg, which was this week's hype stock. Woo! Yes, you. Yes, you, Jen. So, yeah. Why did you lose money, Jen? You know why. Let's go in the Wayback Machine here. Let's take a look and see. So about Wednesday of this week, yeah, the 7th, people were getting really, really excited. Let's go see what this thing looked like on Wednesday. Yeah, July the 7th. Woo, big old bar, big old bar. Man, that is. I don't understand why people feel the need to get in on something like this. Like, maybe it's just I've been doing this too long and I've turned into a boomer about things. But when I see something like this, it scares me. Like this doesn't entice me at all. I don't understand why people look at momentum and think, oh well, it's done this for everybody that got in a few days ago. Now it's going to do it for me. Well, unfortunately for everyone, uh, people that did small brain stuff with GME, for instance, actually got rewarded for stupidity. So never underestimate profitized autism. This year has been definitely bucked the trend. But, some of these things like Tilray, multiple times, they never come back. This when you see big moves like that, you need to go back in time and you need to look and see, how do these things usually go? What usually happens? People usually lose a lot of money on them. And so when you see a big move like you saw in Newegg, which actually, if we look at it here, back in 2020, did the same thing. I guess maybe you had bag holders down here that bought at 22 who are now sitting at double their money a year later. Okay. In general, though, you have better things to do with your capital than take a 75% haircut. Just think about it that way. So on Thursday morning, this was in the chat for Newegg. Okay. I mean, why? I don't know. But if you must get into it, do it right. Do it right. And you saw when I was talking about SPY with the 50% pullback level. So let's just be simple. Let's just look at this from a trading perspective. You want to get in. Let's just take a step back. Let's do a little meditation. And then draw up strategically how we want to play this. Say we come into the open like this. Let's just do it simply. Let's go from the top and go down to the bottom. And let's see, where is the halfway point of this move? Just see. So that's going to be about 44.58. Now, at the open, see if we can, at the open, a lot of people bought in because, oh, it's a big pullback, I don't want to miss this. FOMO. And it actually hung out above there and enticed people for the better part of the morning. But it smacked that level, and at least one person in the chat caught it at that level, pulled a few $100 out of it on that day, held the level. This was a good move right here on a stock in play from here up to around here. That's about 15% move. That's very good. And what's more is it even hit it again at the end of the day, boom, and up it went again, 2 holds at the level. Will it do it again? Is that level still valid? Trading view data, boom, up again. 3 times it held this level. This was not the time to buy it in FOMO, but I get a lot of flack from people that say like, oh, technical analysis, technical analysis is worthless. Like, oh, you're just guessing, Okay, cool story. Yeah, you keep believing that. No, you can find levels like this that work. We did this in real time. We looked at it. What makes it so hard for people in trading is sometimes the easiest things. You just have to, again, lobotomize that stupid out of your brain that makes you want to jump in at the open on something and be patient for it to get to a level like this. And then you can have it just feels so good to catch it. and do something strategically and be able to make money off of when everyone else is losing their shirt because they haven't gotten past that emotional point. So that's how you should have played NEGG, you know? So yeah, great loss porn there for people. So actually, there's another thing I want to talk to about NEGG as well. And this is, some people also wanted to do something dumb, which was buy puts. Okay, I get, let me take that back. It's small brain. Okay. It's not that it's dumb, because thinking that something that's gone up a bunch will have a massive down move, that's using your brain. That's being contrarian. Good. But not understanding how options work and how volatility works, that is where you haven't done your full homework. And actually, for that, I'm going to need to bring up the chart in Thinkorswim, because that's going to give me the volatility that I want. So let's go back and let's look at our favorite of the year, GME. So down here at the bottom on the chart is, let me just clean that up a little bit. We don't need all that. Down here on the bottom is volatility. And I've got an indicator here that charts it for me in Thinkorswim. Here was the price. So when price got up to almost 500, 478 back on 128, implied volatility of GME was at 542%. Now, just to give you an idea of how crazy that is, if you look at the SPY implied volatility right now is sitting at about 14. And at the highest it's gotten is up about 30, 40%. So implied volatility is what options are. Let me back up. Implied volatility is what the market thinks that this stock is going to do, up or down, over the next 30 days. It's implying the volatility. And what happens is they price the options to encompass that volatility. In other words, they're going to make you pay insurance, which is what an option is, on the stock moving that much. And so if you're trying to buy a put at 500 and something percent IV, they've already priced in you not making any money if it gets down to 50 or returns to the mean. It's the price of the option at those time periods, at those days, are going to be so inflated. You could end up paying a few $100 for a 10 put when the stock is at $400, because it's pricing that in. In other words, something coming from 400 down to 10 is going to cost you $200 to break even. You need it not to come to 10. You need it to come to $8 a share, because it's just so inflated. You should only have to pay $5 for a $10 put when something is at 400, because it's so unlikely in any given situation. But volatility expands to the point where it's already priced in. You're just not going to make money buying puts on these big high flying stocks. That being said, you can't short shares, because that is incredibly dangerous. So how do you play the down move? Well, you got to get creative. You got to get real big brain. And I don't actually recommend this for everyone, because it takes a little bit of knowledge about options to do it. But I did a video back in January. There is a contributor to CNBC, John Nigerian, who I have a lot of respect for. He's been on there for a long time. He also sells options courses. But he described his put strategy on GME. And I made a video about it where I analyzed the risk graph. And depending on when he got out, he probably made money on it based on how it worked. So I'm actually going to go through that process right here, like how you should, if you want to get really creative, if you want to get really cute, play a put strategy. So let me bring up Tastyworks. Okay, and we'll make it work for me here. All right, make sure that, all right. All right, so this is Tastyworks platform, which I like for options because you can build complex option strategies and it shows you pretty much what you're looking at down here. So let's start from scratch. So what I want to do is, and we'll just go back to, let's see. We'll go back to TradingView here for our charting. So I want to bet on Newegg going down. Okay, so I want to buy a put. All right. So what I want to buy is a put pretty far down. Let's say we want it to return to where it started because that's what a lot of these things do. We want this to come down to about, let's say about 20. Let me make a different color for that. Mark off our levels. So I really want to get this thing below 20 because I think everyone that bought it at 40 is going to lose at least half their money. That's what I think, hypothetically. Okay, so I want a 20 put. So I'm going to buy a 20 put, and I'm going to go out to November because I don't know what weekly options are because I'm a professional. All right, so that's going to cost about, let's see, let me cheat here and find out what I had. Okay, I had 25. All right, actually it was 25, we're going to say, because we want to get down to 20. Let's say 25 is the range that we're going to start looking at this to get. 25 is where we think this thing is going to break and eventually go down to between now and November. All right, so let's structure this up. So we're going to buy the 25, that's about right, for about $7.90, okay? Now, there's a problem with just buying this put. We have a lot of theta that we're going to lose on a daily basis, and we have a lot of volatility baked in. Remember how we were looking at the volatility here? Volatility at the top on Thursday, or excuse me, Wednesday, was 322%. Yesterday, it was still 259, and then today it's come down to 219. And that's actually dropped a lot over the course of the day. And so for every percentage point of implied volatility, you lose Vega. So if you're looking at your options and you're looking at the Greeks and you see you have the Vega number, every percentage point of implied volatility is how much you lose in Vega. So if your Vega is 4 cents, that means that for every percentage that you lose in implied volatility, you lose $4 hypothetically on your option. So if your Vega is 4 and you buy an option at 322% IV and it comes down to 420% IV, that's 100 percentage points of implied volatility times 4. It's about $400 just right off the bat. Now, if you have delta move down, which you did, you're going to get your delta value. So the price is going to go up and they're going to offset each other to some point. But all else equal, you're going to lose Vega volatility as it comes down and theta as the time goes. Just what you deal with options. So we have to offset these somehow. And the only way we're going to do that is by taking the reverse side, and that means selling options. So how can we sell some volatility and some time? Well, we can do it in two ways, and we're going to do both. We're going to take a short put vertical. And so we don't want to take it really close to in the money because remember, we have our 20 is what we want to go down to. So we're actually going to go pretty far down the chain. So let's take the 15.10. So we're going to do a $5 wide spread all the way down. And because volatility is so high, we're still able to get a really good premium here. We're still able to get about $1.50 in selling this put credit spread where we start to get in trouble around 15. All right. But remember, we wanted to get the 25. So back to buying that one. So that offsets the cost. Instead of paying $7.90 all up front, we're going to offset that by $150. And now we're actually going to be generating theta. No, excuse me, not yet. We're going to. That's the problem we still have. We still have a theta problem. Time decay is still going to affect our trade in buying this put very quickly, $3 to $4 a day. So we need to add a little bit more short volatility and long theta there. So what we can do is instead of just having the single, we can do what's called a diagonal. which means we're going to sell one more option against it. And so that we can get more theta decay quickly, we're going to go closer in time. So we're going to sell a put, a 22.5 put here against it. So now we have 4 legs. We've got our initial play, which is our 25 put that we want. This cost us the most. We've got our put credit spread that offsets us a little bit. And then we've got this shorter dated August 22.5 put, which is still below our main option, our 25 November put. And what that's going to do is, because it's closer to expiration, we're going to get more theta decay. So now we're actually looking at a positive theta trade. In other words, as time goes along, if the price doesn't move, we still are able to make money on it. We've also offset a very, very good amount of our Vega, and we're still directionally bearish. And what this would cost at the closing prices today would be about 410. I actually took a screenshot earlier of what this looked like about midday. And this is what it looked like when Newegg was at 51. It would have cost 345. And towards the end of the day here, it was about 450. So basically, if you would have put this on in the mid part of the day, I'm not sure what time this was, I have to go back and look, but you would have made $100. Now, the full downside risk on this, if you held it and worst case happened, it went all the way down to zero, is you would have lost around about $650. That's if Newegg went to zero. But in most cases, you're just going to be out what you put up for in this debit here, 345 in this case. But by the end of the day, it would have been back up to 410. And if we look at some of the differences in the prices, if we compare left to right here, let's bring this over, hang on. So our main put, it went from 810 to 790. It lost 30 cents in value, even though $51 when we first evaluated it here, $46. We had 2.5 delta move in the stock, but we actually lost money on our put. How does that happen? Volatility crush. All the options are worth less by the end of the day, because even though the stock went down almost $3 in that time, volatility went down to offset it. So even though we got the movement we wanted, we still didn't make any money on this option. This is why you can't buy single options on these hype stocks. You can't buy single puts. You just can't. It's dumb. You have to offset that. But because every option lost value, including our shorter dated August one, went from 225 down to 205, and then our puts credit spread also sold off, we actually would have made money, because it would have been a debit 345 up to 410. So we made about $60 roundabout? Yeah, something like that. $65 just in that time, from it going from 51 to 46. But if we just done a single put, we would have lost money. So if you're going to want to play these moves, you have to be smarter than your average, retail trader that just started a few months ago. You got to really dig into these complicated option strategies to offset all the aspects. So that is how you should have played Newegg. So all right. Do I really have to moderate my chat? All right. What else has been going on? Guys, if you have any questions, just let me know. Otherwise, I'm going to keep on ranting. NVIDIA. This is something I talked about in the live stream last week. So NVIDIA is one that got into back in May, and it has been ripping into the split. And that's what I've expected it to do. But unfortunately, some people are only just now noticing it in the last couple of days. and buying in over 800. I'm already in, so I'm talking about it. I don't know what to tell you if you're trying to buy it now. And if you lost money in this recent down move, I'm sorry. But it goes back to the whole FOMO of Newegg. Once something has gone up this much, you can't just think it's going to do it for you too. You got to get in when things are boring. I mean, look at this crazy price action in here on Newegg. Actually, all the way from September, it was boring. No one was yelling and screaming about it. Not a single damn YouTuber was making a video about it. Nobody's posting about it. But that's when you had to get in. You need to look at trends like this that have gone a long way, and you just need to tell yourself, you don't get to win if you buy it here. You're just not going to win. You're not. You need to tell yourself that. Like when you see something like this, you're like, I want that. I want those gains. I've taken so many losses. I really deserve some wins. No, you don't get to win. You have to take risk when no one else is looking at something. The people that made millions of dollars on Tesla were the ones that bought it in 2018 when everyone said they were going out of business. You had to be in when everyone was going against it. That's the only way that you're going to make these big gains. You don't get to jump into something because everyone else is. What's going on psychologically is you think that if you're part of the crowd, if everyone's yelling about it, if everyone's excited about it, you feel this warm sensation, this comforting sensation of being in agreement with people. It's a fallacy of human nature, and it costs people a lot of money. You have to be a contrarian to make money in this business. You don't get to win jumping in on the hype. That being said, I'm still holding through the split till about 2 days afterwards. Now, that could be the wrong thing. It could come down right here. I don't care. I've already taken profit before earnings to make this a free trade for me, so I don't care. I'm going to stick with the strategy that I've looked at based on Apple and Tesla last year. And that tells me that I need to hold it to the split and then sell into it. And the best part about that is now, let's say you owned just one share because you just could buy one single $500 share down here. Now you have multiple shares. So you could sell one, you could sell two, you could sell three. But the movement I'm expecting from here, this close to the split, is maybe a few percentage points. Let's just say from here, you get about that much. Maybe it's going to hit $900. What kind of risk are you taking on, though, at this point? I mean, this isn't going to double in a week or two. So what are you really trying to do? I mean, people that were trying to buy it, when I started getting these questions, when it made all-time highs up here, what are you trying to do? If you took a one-to-one trade trying to get it up to 900, well, you would have been stopped out. I mean, you can't jump into these things once they've already happened. But I mean, you had plenty of time to do your homework in this last month. They announced the split, I believe, May the 20th. So it was before earnings. And you've had a whole month of June to make money on this. You missed it. I still think, so basically, I still think it's going to go up into the split, but you can't buy it now. It's over. It's done. On to the next one. Learn from it. Don't know what else to say. All right. What's next on the list? So we're coming up to the end of the live stream. Good hour here. Want to take one look at the VIX. Now, a discussion came up today. Actually, say I want to look at the VIX, and actually, yeah, we'll use this as here. Discussion came up today about what I think about China and the US and what that has to do with the market. I don't know. That's beyond my pay grade. Macroeconomics and trying to guess what the People's Bank of China is going to do. I mean, come on. Why are you asking me that question? What I can look at is something that is available to me, and that's looking at the VIX. Now, I'm looking at the VIX. I'm not looking at the UVX, VZZY, or whatever triple leverage garbage that people are trying to play. That's not what you use for analysis. Use the VIX. The VIX itself is a derivative of the implied volatility of the forward 30 days of SPY options, which are a derivative of SPY, which is a derivative of the S&P 500 index, which is a derivative of the component stock. So the VIX itself is a derivative to the fifth power. So why are you looking at a sixth derivative? If you want to trade it, if you want to blow your money on these leverage products, be my guest. But if you're doing analysis, use the VIX. Now, what the VIX does, because if you're an options seller, you have a couple of mantras. Number one, fear is overpriced. And so generally speaking, volatility or implied volatility is overstated versus realized volatility. In other words, the actual volatility that ends up happening is not nearly as much as is priced into the options. And that's what option sellers try to bank on, is that they're going to say, okay, you're really afraid of this movement. I'm going to sell you this insurance premium because I don't think it's actually going to happen. But the implied volatility, and that's why I call it the fear index, is the measurement of how fearful people are. Now, what ends up happening with the VIX, because volatility, another mantra, is that it is mean reverting. And what you'll see here is that very oftentimes you will have the VIX come back to my favorite 50% retracement levels, oftentimes even more often than regular price charts. So what are we looking at here? Why are we drawing these levels? So from this low right here up to the highs here, why did we get this move here? So let's do a little drawing here. So these big moves create events that we can look at in the future. So let's draw these up right here. Lots of different levels that oftentimes VIX will spike to. And if you look and go back and look at the SPY, let's see, can we do a compare? Yeah, let's do it. Let's see if the SPY compare will look. Okay. Yeah, that works. So the SPY and the VIX are inversely correlated. And oftentimes what you'll see is the VIX will lead the SPY. You can see potential market bottoms based on spikes in the VIX. Back when we had the May the 12th spike, we came up to this level right here, and that was a major market bottom around May the 12th. Just like in January, when we had the big crazy meme stock short squeeze crash, also spiked up to a level. A couple of others we had in February, boom, boom, were also spikes that held here. If you draw these lines up and set alerts, you can begin to see where fear is reaching a maximum point based on past fearful moves. And this can be levels where you start to want to get long the market. You can time the market using the VIX. So I don't know what the news is going to happen about China or whatever gobbledygook the Fed is doing, but I can look at this and I can get a pretty good idea of what I need to do for tradable signals. There's also something kind of cool that happened. Let's bring it up on Thinkorswim because again, the data is oftentimes much better in Thinkorswim. That's because I'm cheap and I don't pay for the expensive data. But let's look at the VIX on the 30-minute. Let me clean up that I don't need. Okay. So this week, very interesting thing happened on the VIX. So Friday of last week, the VIX made a very major low. In other words, if we look here and we look at the VIX over the weekly time period, We were much, much lower back in 2020 before the crash. But as far as the last year goes, we made a major low on Friday of last week. And so that was significant because we were also making an all-time high. But into this week on Tuesday or Wednesday, when we made a new all-time high on the VIX, we did not make a new low. Excuse me, a new all-time high on the SPY. We did not make a new low on the VIX. There was a disconnect. There was a divergence in the VIX, the volatility, and the market itself. Market was saying, woohoo, all-time high. VIX was off its low. There was something very different. There was something divergent about them. In fact, from a price action perspective on the VIX, from the low that it made up to the elevated high on Tuesday, and I noticed this because the market was going up, but the VIX was going up at the same time. You don't see that. Remember, they're inversely correlated. It also came down and found on the VIX its own support right here, short term, between Tuesday and Wednesday. Even while the market on Wednesday was making a new all-time high, the VIX couldn't break lower. There was still something out there in the market. I'm not going to attach a reason to it, but the options prices were not convinced that we were going to go up even further. And sure enough, boom, market goes down on Thursday, VIX shoots up. So where are we now? At a new all-time high. Well, I know where we're not. The VIX has not made a new low. So while the market, the SPY, has made a new all-time high, options prices don't yet agree. So I'm going to leave it at that to finish out the week. Hope you all had a good one. Make sure that you like, share, subscribe, all that good algorithmic stuff. And again, join on social media. I want to talk to smart people that I can learn from, and more than happy to share what I know. So trade wisely and have a great weekend, guys. We'll see you next week.